Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday.
This week, we're going to have a look at the latest reporting from S&P 500 companies and an interesting shift in the narrative around AI. We'll also have a look at the latest with regards to inflation and growth in the US, a key leading indicator for the Chinese economy, and finally, we'll have a look at South African property prices. We're going to start off with the S&P 500 reporting cycle. So far, we're about 70% of the way through, and of the companies that have reported, 75% have beaten on the earnings line. And that's a pretty good proportion to be beating on the earnings line. And in addition to that, earnings growth at this point is looking like it's going to be about 13% year on year, which is very good compared to inflation. So it's been a good reporting season. But even so, we have seen a broad-based sell-off in a number of different companies in the US. And I think there's two things at play here. Firstly, we're seeing a shift in guidance from corporates. If you listen to those earnings calls, it's increasingly the case that corporates are cautioning around the potential for AI to disrupt their business, either leading to potentially lower margins in time because there's some AI equivalent out there somewhere, or requiring huge amounts of capital investment just to keep up. And investors are increasingly concerned about the potential return on capital for this investment. So broadly, the AI narrative has shifted away from one of optimism and companies rallying when they have anything to do with AI to one of concern, where companies may be threatened. At the same time, we're seeing a huge surge in coding output. If you look at the number of new websites, that's up 30% year on year. If you look at the number of new iOS apps, that's up over 50% year on year. So we're seeing the surge in coding productivity, and that too is leading to concern that we're going to land up with apps and code that's going to be able to threaten the viability of certain business models. And as a result of that, if you have a look at it as an example at the S&P software and services sector, that's taken a sizable hit. It's down around about 20% off its recent peak. And to put that in context, that's not too different from what happened during COVID. It's not too different from what happened during 2022 when there was a concern around a recession and there was rate hike concerns too. So it's been a pretty sizable sell-off in software and services as an example, but it's not just software and services. It's any sector or company that looks like it might be threatened with increased competition coming from AI code. And this is going to be a key theme running through markets over the next couple of years, something we're going to have to monitor very closely. But it is just interesting how the AI narrative has shifted from one of optimism with regards to what it means for markets to now one of concern. Switching to global inflation, we've now had inflation prints for 35 of the 50 largest economies across the globe. And global inflation has ticked down from 2.5 to 2.3%. It is interesting to note that what we're seeing now is that inflation globally is fluctuating between sort of that 2.3 and 2.5% level. And pre-COVID, it would typically be sort of 1.7 to 1.9%. So inflation has settled at a level which is quite a bit higher than it was pre-COVID, and at a level which is likely to still be quite uncomfortable for a range of central banks. And so we need to keep a close eye on this. We need to see if it does ultimately drift down towards that 2% number. But as things stand, it's looking pretty sticky at a number above 2. And speaking of inflation rates that are pretty sticky at a number above 2, we did see a decline in US inflation. It came down from 2.7% to 2.4%. That was a bit below the consensus forecast. And as a result of that, we saw quite a bit written about the potential for US inflation having been beaten and that US inflation is going to be heading to 2% sometime soon. And that's probably optimistic at this point. Monthly inflation in the US was 0.2%. If it stays at that level, year-on-year inflation is not going to be getting anywhere close to 2% anytime soon. In fact, by June, it will increase and be at about 2.8%. So monthly inflation hasn't got yet to the level where we can say that US inflation has been beaten. And in addition, there are some indications to suggest that US inflation, in fact, is likely to increase off current levels. If, for example, you look at the ISM Services Prices Paid series, which is a key leading indicator for US inflation, that points to an environment where US inflation is going to be ticking up to levels of around about 4% within the next 6 months or so. Now, that is just one indicator, and it may well be the case that US inflation doesn't get to 3%, never mind 4%, but it does suggest that the US inflation battle hasn't yet completely been won. And if you look at the background, in fact, what's happening is that shelter inflation continues to drift down. It's now sitting at about 3%, and inflation ex-shelter is sitting at 2%. So even if shelter inflation ultimately gets down to 2%, if inflation ex-shelter is at 2 or above, we're going to land up in a situation where US inflation is above 2, and we're going to sit with a Fed that's going to be unable to cut very aggressively. So this, again, is going to be a key story over the coming year. This is something we are going to give a lot of attention to. We need to focus on what is inflation ex-shelter, and if that series starts to tick up quite materially, we'll have to revisit our expectations for Fed cuts over the coming year, even if there is a new chair. Onto the job situation in the US, we did see the non-farm payroll print come out last week, and at first glance, it was pretty good. Non-farm payrolls increased by 130,000. That was quite a bit more than we saw the month before, and quite a bit above the consensus forecast of 65,000. In addition to that, if you look at the 3-month average, which is probably the best gauge of the employment situation given the volatility of the monthly numbers, that number ticked up too. It's over 70,000, up from the minus 22,000 the month before. So again, at first glance, this looks pretty good, and it does seem that the US labor situation has turned. But, and there's an important but here, there have been some pretty sizable revisions to the non-farm payroll series over the past couple of years. As an example, if you look last year, on average, each month was revised down by over 80,000 jobs. In total, for the full year, the number was revised down by over 1 million. So we can't have too much faith in that current print that it sits at the moment, because it could be revised down, if it's in line with last year, by another 85,000 jobs or so. So we need to wait a couple of months at least to be able to say that the number that came out is actually in line with the final number. In addition to that, there are other indicators suggesting that the labor situation is cooling in the US. For example, if you look at the number of job openings, there was a steep drop-off, down over 300,000 jobs in December. And that tells us quite clearly that the labor situation is deteriorating. And there's a couple of other indicators we can look at too. The unemployment rate is still sitting just a bit above 4%, so it's not very high, and we can't say that the labor market is weak. But what we can say is that it's no longer as strong as it was before, and there are very few indicators suggesting that it's going to strengthen over the coming year. And we do land up then with a pretty strange situation. We'll get the Q4 GDP number coming out this week. If you look at the Atlanta Fed numbers, it's going to be about 3.7%. If you look at consensus, it's going to be about 3%. Either one of those will be pretty good, and they'll be pretty strong numbers. So we've got a US economy which is pretty strong. The GDP growth of somewhere between 3 and 4% based on the key leading indicators, and an employment situation which is just a bit better than stagnant. It doesn't often happen. AI might explain a little bit of that, but we think it's too early for AI to explain all of it. And we need to dig a little bit to try and get a good idea for A, why we're seeing such sizable revisions for the US labor data, but B, why we have such a sizable disconnect between the GDP growth numbers and the employment numbers. And this too is likely to be a key theme, certainly for the Fed, but more broadly for markets over the coming year or so. And that gets us to China. And here we've seen some encouraging data coming out. Chinese money supply growth is now up over 9% year on year, and that's a key leading indicator for economic activity. And if you look at total social finance, which is the key leading indicator for Chinese economic activity, and typically there's a lead of about 9 months here, that series was down quite materially year on year. The 3-month average is now about flat year on year. And so we can have some greater comfort that Chinese growth is not likely to go through a soft patch over the coming 9 months or so. And in addition to that, there's still ample scope for stimulus. Chinese inflation is still barely above 0. The target is 2. So there is still ample scope for trying to get the economy to accelerate, for trying to get domestic demand to pick up. And we are seeing some announcements in that regard. And so for us, we don't need to be as negative as we thought we might have to be with regards to Chinese growth. And clearly that's quite helpful for commodity prices. And that takes us to South Africa. We've spoken a lot about some of the tailwinds for the SA economy. The higher commodity prices globally, which are leading to higher profits and an improved fiscal position in SA. We've also spoken about the structural reform program in SA, which has been quite successful. SOEs are performing much better than they did before. We've created our own SOE index. It's currently running at the level that it did in 2021, well above the level we saw in 2023. And all of those are key tailwinds for the SA economy. And quite generally, a lot of them have been reported on in the press. What I think has been so far neglected and has escaped the broad attention is what's happening to SA house prices. The broad index is up 6.3% year on year, which is well above inflation. That does mask some variability. If you look in the Western Cape, house prices up about 9% year on year. If you look in Gauteng, they're up about 3.8% year on year, which is still a bit above inflation. But we are starting to see potentially the genesis of a housing improvement, of a wealth effect that's developing in the housing market. We need to keep a close eye on this. Should it continue to be this case over the next sort of 6 to 12 months, and we see house prices continue to inch up and the growth rate continue to accelerate, we would expect that would provide another tailwind for consumption in SA. So we'll provide an update on this in about 6 months or so. We'll just keep an eye on it in the background. If something does shoot out, we'll report on it earlier. But in the interim, hopefully it's going to be a slow burn story over the coming year or so, and another reason to expect consumption to pick up in SA. And we'll leave it there for this week.
That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that are referenced in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity, Equity Derivatives, Currency Derivatives, Bond Derivatives, and Interest Rate Derivatives markets, an authorized financial services provider and a registered credit provider.